Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Rasulihil Kareem wa ala alihi wa sahbihi ajma'in. Wa man tabi'ahum bi ihsanin ila yawmiddin amma ba'd. Welcome back to this weekly lecture of Islamic Economics Association, Kuwait University. And today we are going to invite Dr. Salman Ahmed Shaikh for this lecture today. And inshallah, in a while, I believe he is joining us in a while, in few minutes, inshallah. So distinguished guest, ladies and gentlemen, inshallah, we are just waiting for our guest speaker few minutes, inshallah. And I believe he is joining very soon and we can start the session. As you know that we are Islamic Economics Association, نادي الاقتصاد الإسلامي بجامعة الكويت is organizing various types of events, programs, such as training workshop, lectures, forums, and conference. And also the association is trying to publish some articles, scientific articles and research papers in our website, www.sharia.org. So we are inviting scholars and researchers. If you have any scientific research papers or articles, you may email to our email ID, as you can see in the below, iec.sharia@gmail.com. So if you have any research paper and article and you want to publish it in our website, most welcome. And we'll be pleased to receive any scientific paper or research paper related to Islamic finance and banking, Islamic economics. And our review board will review it and then we can publish it in our website, inshallah. And English programs, about English programs, we are hosting international figures and experts from around the world, from the prominent and famous institutions, universities, centers, and banks, global platforms. And we conduct these seminars, talks, and lectures every Thursday. And sometimes we are also hosting some workshop to promote Sharia compliant finance models and also to present the Sharia compliant resources, methodologies, practices that have been practiced in the Muslim countries, in Islamic banks and institutions. So this is one of the great khidmah and service by our institutions, association, Islamic Economics Association. So Alhamdulillah, as you know, we are receiving participants from around the world in Arabic programs. Every day we are having Arabic programs in a specific topic of Islamic finance and economics. And so We are very much honored and pleased to have you in our sessions in every programs, and our association is very much pleased to welcome all the participants. So we believe that you may also promote our association to other people known to you and institutions, so that we can globally provide services of Sharia, Islamic finance and economics. We are just waiting for Dr. Salman Ahmed Shaikh. I'm trying to reach him. Just a while ago, I have talked to him. Inshallah, he'll be with us in a while.
بسم الله والصلاة والسلام على رسول الله وعلى آله وصحبه ومن والاه، وبعد. أحبتنا الكرام،
ها هو نادي الاقتصاد الإسلامي بجامعة الكويت يضع بين أيديكم جدول برامجه لشهر فبراير، مبادرة منه لحفظ الأوقات وسعيا لنشر العلم الشرعي والمساهمة في نهضة الأمة.
واعلموا أن مجالس العلم موائد كرم، وفيها كل المغنم وأي مغنم. فضائل مجالس العلم كثيرة، وأجورها وفيرة، وخيرها عميم، وأجرها جزيل.
نادي الاقتصاد الإسلامي بجامعة الكويت موئل العلماء ومنهل الفضلاء ومهوى أفئدة طلاب العلم الشرعي من كافة أرجاء العالم.
فبالعلم تبنى الأمجاد وتقوم الحضارات وتسود الشعوب. العلم يبني بيوتا لا عماد لها، والجهل يهدم بيت العز والكرم.
وأن إنقاذ الناس من الضلالة وإخراجهم من الظلمات إلى النور أفضل قربة، فلأن يهدي الله بك رجلا واحدا خير لك من حمر النعم.
حياكم الله، أحيوا العلم والأدب وانشروا العلم بين العجم والعرب.
The programs and activities usually cover a wide range of areas in Islamic banking, microfinance, insurance, capital market, equity market. The features are Sharia principles of Islamic finance.
ووفاؤكم لبرامجنا يثلج صدورنا. توضع روابط التسجيلات لحضور برامجنا يوميا على قنواتنا ومواقع التواصل الاجتماعي للنادي، فلا تترددوا في حضورها واحتساب أجرها وتحصيل نفعها، فإنها رياض الجنان.
Thank you very much, our brother, for this video. May we present our video of certificate. Dr. Salman is trying to join, but يواجه المشكلة لا أدري لماذا. Brother Yahya, can you please look at that?
القاعدة الفقهية حكم كلي. اجتهد العلماء في طريقين لاستنباط الأحكام الشرعية الكلية، يعني للقواعد الفقهية. الطريق الأول الاستقراء، والطريق الثاني الاستنباط.
أنا الآن ذهبت إلى بيت التمويل الكويتي، فأريد أن أشتري منه سيارة بالمرابحة.
يأتي عندنا الآن حساب الراتب من الناحية القانونية، حساب الراتب مستقل، لكن أحكامه شروط والأحكام التي تنظم علاقة العميل بالبنك في حساب الراتب نفس الشروط والأحكام التي تنظم علاقة العميل في الحساب الجاري مع البنك.
هذا الوصف أنه خطر احتمالي يعني ينطبق عليهما الاثنين، على التأمين العام والتأمين الثاني يسمى أيضا بالتأمين على الحياة.
قد يكون التجديد في العلم نقض الأشياء أو نسخها أو إضافة أو تهذيب أو تشذيب وما إلى ذلك، أو يكون التجديد في الوسيلة،
يعني تعتمد على أداء عمل معين، تستأجرني لأقوم لك بعمل معين وهذا لا بأس به، فتعتمد على أداء عمل معلوم.
فأنت تحاول دائما أن تشدهم بقوة المعلومة وبالصياح وبالجرس.
لماذا السوق متجه أو الشركات أو البنوك متجهة بكثرة، وكذلك الحكومات تتجه إلى إصدار صكوك الإجارة عما سواها من الصكوك؟
ولكن نحن عندنا في الشريعة الإسلامية الجوائح، وهذه الجوائح يعني عرفها العلماء هي كل آفة من صنع آدمي أو غير صنع آدمي.
Okay, thank you very much, distinguished guest. We are still waiting for Dr. Salman to join. He is facing some problems in joining, but we believe that he is joining us now, inshallah. Dr. Salman, welcome, please. I think he joined already. Dr. Salman, can you hear me, please? I think now the problem has been fixed. Hello, Dr. Salman. We can't hear you. We can't hear your voice. Okay, dear brothers and sisters, distinguished guests, today's topic is alternative pricing benchmark for Islamic finance. And our guest speaker today is Dr. Salman Ahmed Shaikh, who is the project coordinator and editor, Islamic Economics Project, Pakistan. And he's also editorial advisory board member, Emerald International Journal of Islamic and Middle Eastern Finance and Management. Dr. Salman has obtained his PhD in economics from the National University of Malaysia and Masters in Economics from Institute of Business Administration, Karachi, Pakistan. In Islamic Economics and Finance, he has published papers in SSCI, Scopus, and ERA index journals, along with chapters in books published by Web of Science publishers. And he has as well presented in international conferences in Turkey, Malaysia, Japan, Brunei, Indonesia, and in Pakistan. Dr. Salman is the recipient of 2 Emerald Highly Commended Paper Awards. He is also editorial advisory board, as I stated earlier, and he is also editor of Moral Reflections on Economics, which is a monthly periodical published by Islamic Economics Project. So let's welcome Dr. Salman. Dr. Salman, can you hear me, please? Hello, Dr. Salman. Ahlan wa sahlan. I think there is some problems in microphone or in voice. We cannot hear you, Dr. Salman.
Is my voice? Yeah. Is my voice clear?
Now it's being clear, but not clear completely, I guess.
All right. Now, is it better?
Yes, yes, yes. Please, you may start and we will see if there is any problem in voice. We can fix it up again. Yeah, no problem.
All right. All right. Can you share the presentation if you have it?
Sure, sure, sure. No problem. Yeah. I think I already shared. I think it's visible now.
Yes, it is visible. Can you make it full screen?
Already I make it. I made it already.
All right. All right. Can you move to the first slide? All right. Thank you once again to the organizers for inviting me. Sorry for the delay to the host as well as to the participants. There was some logistical problems, but now, Alhamdulillah, we are here. So this is a very important topic, and it's a current topic, and it's a very important, you can say, stage for Islamic finance, where we are seeing that there is a transition happening in intrabank benchmark rates. The whole world, the financial market is moving away from LIBOR. And now this is an opportunity for Islamic finance and especially Islamic banking to also see that what alternative benchmark can be used in Islamic finance. We have been thinking of using alternate benchmark rates in Islamic finance, which are more oriented towards real economy, which are more reflective of the kinds of contracts and the kinds of risks that are involved in Islamic banking and finance. But we have not been able to transition away from LIBOR. But now, since the LIBOR itself is being phased out, and now there is an opportunity for Islamic finance as well as for global finance to move away from submission-based intrabank benchmark rates and use an alternate benchmark rate. Now, we are going to discuss that the LIBOR is now being phased out, and we are already in 2022, and LIBOR is no longer available for many of the maturities, and now there is transition happening. The different alternate benchmark rates that are formulated, that are proposed in the financial markets are quite a few, but they still have problems with regards to Islamic finance. We are going to discuss that what are the issues that are faced in the new alternate benchmark rates, due to which it is necessary for Islamic finance that it should not just simply move from one alternative to another alternative, which is equally going to be problematic from the Sharia point of view. So we are going to look at what are the different alternatives that are there in Islamic finance. There is one view, which is the interbank market view. There is another view, which is the economic market view. So we are going to see that what are the discussions involved and what are the alternatives that have been proposed in these alternative views and what are the pros and cons of these alternatives. So this is my presentation outline. Let's move to the next slide, please. So if we look at LIBOR, LIBOR had certain problems due to which it has now been phased out. And if we enumerate the problems that were there in the LIBOR based interbank benchmark rates, the problems were that it was subjective. It was not transaction based. It was just a submission based benchmark. So banks could make a cartel, banks could manipulate it, banks could join hands, and they would drive the rate below a certain level or above a certain level. So this was very much possible. The manipulation was possible, cartelization was possible, and banks were very few, and the system was not very transparent. And because banks were not committing to a particular transaction, they were just simply submitting that hypothetically this would be the rate that they are going to trade at. So they would say any rate because they do not have to eventually execute a transaction based on the submitted rate. They were not really very careful in submitting their rates. So it was subjective and it was not transaction based. And it also did not have enough number of transactions to have a robust calculation. So only a few banks were participating and they were just submitting the rates on which the transactions were not happening. So it all became quite weak from the robustness point of view and also not very transparent from the point of view of having an average rate which is reflective of the overall market. And it was also susceptible to rigging and manipulation. There were cases found of banks involved in manipulation. And then financial regulators thought that it's enough. We should move away from LIBOR. So LIBOR is now being phased out as we speak. In 2022, we are going to be using different rates. These rates are going to be different in structure from LIBOR, and we are going to have a summary of these in the next slides. Can we move to the next slide? Yes, so this is just a summary of what are the alternate benchmark rates that have been proposed other than LIBOR. So we see that there are different rates in different currencies and there are different rates in different regions. So for instance, when we talk about secured overnight financing rate, it is basically replacing the USD LIBOR, and it is going to be administered by Federal Reserve Bank of New York. Likewise, there are different other alternatives like Sonia, like Easter, like Tonar, like Saron. So all of these different rates are in different currencies for different regions. But the one common thing in all these rates is that most of these rates are backward looking. They are not forward looking. Now, LIBOR was a forward looking rate. And when you use LIBOR in a transaction, you knew the pricing. Now, the issue with these alternate benchmark rates or alternate reference rates is that they are backward looking. So you would not know the exact rate while you are entering into a transaction. Now, this creates a problem from the point of view of Islamic finance, because in Islamic finance, we say that when we conduct a sale transaction, the price has to be unambiguously known. There should not be any uncertainty related to the pricing. If price is uncertain while entering into a contract, then this contract would become invalid because of the involvement of gharar in pricing. So this is one issue that we come across, one very important issue that we come across when we think about what should be the next step for Islamic finance. We cannot simply transition to these alternate reference rates, especially if they are backward looking. Now, some of these are forward looking as well. And because it's an ongoing issue, now the regulators are devising the forward looking rates as well. But in most of the alternative reference rates, what we see is that they are backward looking. And another problem that comes in is that LIBOR was available for different tenors. It was available for overnight basis. It was available for a few months to few years. Now, the problem with these alternate reference rates is that they are just overnight rates. So you have to add the maturity risk premium. You have to add the credit default spread. Now, when you do not have this thing inbuilt into the benchmark, this would create a bit of a problem of standardization, because someone would calculate a maturity risk premium in a different way. Someone would calculate the credit default spread in a different way. So this is another issue which we find in alternate reference rates. Can we move to the next slide? Yes. So this is just a summary of the difference between the earlier interbank benchmark rates. LIBOR was one of them, and there were other benchmark rates like K-LIBOR for Kuala Lumpur, KIBOR for Pakistan, likewise Bangladesh, likewise other countries had their own interbank benchmark rates. Now, all of these rates are going to be replaced by these alternate reference rates gradually. Not necessarily they have to be replaced right away, but the point is that there has to be a transition, because when we enter into cross-border transaction, when we enter into transactions in which banks of different jurisdictions are involved, mostly USD LIBOR was the benchmark used. Now, if USD LIBOR is not available, we will have to now go for SAFOR. We will have to go for other replacement of USD LIBOR in cross-border or foreign currency transactions. Now, if we look at the comparison of interbank benchmark rates, just like LIBOR, or the alternate reference rates, which are the new risk-free rates on overnight basis, what we see is the differences in terms of maturity risk premium. In interbank offered rate, we had the rate available for different maturities, but in alternate reference rates, we do not have that luxury. We only have the overnight rate. And while the interbank offered rate was submission based, the alternate reference rate is transaction based, and the transactions volumes is huge, is very huge, and that is one feature which makes the alternate reference rates to be more robust as compared to the interbank offered rate. But the problem with alternate reference rates from the Islamic point of view, Islamic finance point of view, is that they are backward looking, whereas interbank offered rate were forward looking. And from the point of view of gharar in pricing, we are better off when we are using the forward looking rate as compared to using a backward looking rate. So yes, there was a problem in LIBOR because it was interest based, but the alternate benchmark rates are also interest based, and they also have this problem of creating gharar in pricing because of this feature of backward looking benchmark. And then another problem in alternate reference rate as compared to interbank offered rate is that there is no credit risk premium. In interbank offered rate, at least there was a risk involved, which was risk of a bank, which is not government, so it does not have a zero default risk. We know that governments on their local debt have zero default risk because they can issue currency and they can repay their debt. But same is not the case with banks. They have to borrow when they are in trouble, and sometimes they can default as well. They can go bankrupt as well. They can be bank run as well. So banks are not like government that they do not have a zero default risk. They have a non-zero default risk. And that is why in interbank offered rate, there was some sort of risk element involved. But these alternate reference rates are risk-free rates. These are risk-free rates. So you would have to add a credit risk premium. You would have to add a maturity risk premium. Now, the problem in alternate reference rates from an Islamic point of view is that we do not have forward-looking rate in most cases. And in cases where we do have forward-looking rate, it is based on the transactions in the derivatives market. So the underlying transactions are not Sharia compliant as well. They are either derivatives or they are repo transactions, which are not allowed in Islamic finance. Can you move to the next slide? So this is just a comparison of SOFR, which is an alternate reference rate, replacing USD LIBOR, and a comparison is made with 3-month USD LIBOR, because SOFR is an overnight rate. So the lowest frequency in terms of maturity we have for LIBOR is 3 months. So if we use 3-month LIBOR against SOFR, what we see is that they are moving very close to each other. So meaning that they can be used as a substitute. So the global financial markets do not have much of a problem when they are transitioning away from LIBOR to SOFR. But the problem in Islamic finance is that we want to avoid gharar in pricing, and we also want to avoid non-Sharia compliant underlying transactions. So we know that these risk-free rates are based on repo transactions, and these repo transactions would have treasury securities as underlying. So these are not compliant with Islamic finance. So what Islamic finance would like to have is a benchmark rate which is reflective of the kind of risk that Islamic banks and Islamic financial institutions take, and which is also reflective of the real economy-based productive enterprise. Can we move to the next slide? So this slide again shows the moving average of SOFR and USD 3-month LIBOR. So another way to look at the same graph is to take the moving averages. Now, what do moving averages do? They smooth the curve. So if we use the moving average, what we can see is that the SOFR is less volatile as compared to LIBOR. So from the point of view of volatility, these alternate reference rates are very much reliable. From the point of view of robustness, they are very much reliable because they are transaction based and the transactions are huge and voluminous. So there is no issue as such when it comes to volatility, when it comes to transparency, when it comes to robustness, when it comes to data availability. But the problem comes in Islamic finance is the gharar element in pricing, and the fact that we have to add credit default spread, which is not there by default in alternate reference rate. Can we move to the next slide? Yes, so this is another graph which is comparing SONIA with the 3-month USD LIBOR. So SOFR is a rate which is a replacement of USD LIBOR, whereas SONIA is a rate which is a replacement of um, UK based interbank benchmark rate. So we can see that they are moving in tandem and they can be used as a substitute. There's no problem in terms of economic comparison, but there are some issues with related to Sharia principles. Can we move forward? Yes. So if we look at the Islamic alternatives that have been conceived, that have been developed, what we see is that there's one rate which was offered by Thomson Reuters in 2011 that was known as Islamic Interbank Offered Rate. Now this was launched in 2011, but the problem with that rate was that it was also very much like or in its structure. It was submission based, it was subjective, it was not backed by a lot of transactions. And the issue with Islamic money market is that there are much less activities in Islamic money market as compared to conventional money market. So the problem was that this rate could not be used as a benchmark even by Islamic financial institutions because not many transactions were happening. And this rate was dependent on submission by Islamic financial institutions. Now, Islamic financial institutions world over are a very small part of the overall financial market. So that is why they are not in a position to determine the price. They are basically just in a competition with the big players like conventional banks, and they tend to match price rather than lead price determination. So mostly Islamic financial institutions kept referring to LIBOR. Even when they were submitting their rates, they were using LIBOR as a benchmark. So this really could not go much forward. And in fact, one of the organizers of this rate conceded and basically admitted that after a certain number of years, even Islamic financial institutions were not willing to submit the rate. So it became too much, you can say, out of relevance. And then in 2016, 2017, they thought that, well, instead of just publishing it, if nobody is using it and if nobody is bothered to submit to us the actual rates, then what's the point of using it? So they discontinued publishing it. And now when the whole world is moving away from LIBOR, we cannot really go back to IIBR, which was in structure just like LIBOR, a submission-based rate determination system where we are not having two transactions, and in Islamic money market, the number of transactions are even lesser as compared to conventional money market. Can we move to the next slide? Yes, next slide. So this slide basically just mentions that how this rate was determined. So basically, this was a question which is written in the last profit rate that you would distribute for an interbank Sharia compliant fund transaction, or you do so by asking for and accepting interbank offers for a market amount of USD for 10 spacing below. Now, this is a question which was asked to Islamic financial institutions, and they would submit a rate. Now, this rate which they are going to be submitting is a rate which is not transaction based. It is just their own perception, own let's say willingness to offer or willingness to pay price. So this is not actual market price. So this is subject to manipulation. This is subject to all the behavioral biases and behavioral issues in thinking about reality. This is not based on facts. This is just how a particular bank is thinking of the market situation at a given point in time. So this was not really ideal, and it was just like LIBOR. So if the world is moving away from LIBOR, we cannot go back to this system anymore. Can we move to the next slide? Few other issues were also there in IIBR. which were like time differences. So it was basically based on Makkah time. But we know that Makkah time is much later than the time in the South Asian or Southeast Asian, East Asian markets. So Malaysia, Indonesia, and other markets would wake up too early, and they would be needing the rate, whereas the rate which was being updated in IIBR was based on the Makkah time, which was much farther. So this was also one problem, and it was also just single currency based, just USD based. So it was not really incorporating the different currencies as well. So it largely remained a quoted rate, and that is why it went into irrelevance after a certain period of time. Even though there were studies found that there was a close correlation between this IIBR and the LIBOR. And it's not very surprising, because if the Islamic financial institution is operating in a market where the conventional players are very big in size, and we are entering into a USD based transaction, we are entering into a cross border or foreign currency transaction. So we cannot dictate price. So what we will look at LIBOR for reference. So even if Islamic financial institution is offering a particular rate, back of the mind, there is LIBOR in picture, and definitely for commercial displacement risk, it cannot be avoided. Commercial displacement risk means that if, let's say, we are offering the same kind of service, which is providing funds or taking funds in deposits, if the product nature is same, that then the price cannot be too much away from the market price, because if it will be, then we would not be able to get the market, because someone would go to the cheaper substitute. So we had that commercial, you can say, pressure to not deviate too much away from LIBOR, and that is why Islamic financial institutions were by and large just focusing on LIBOR even when they were quoting rates for IIBR. That is why it is no surprise that when we would do a correlation between the two rates, they would turn out to be very much same. Can we move forward? Yes. So this slide basically summarizes the different alternate benchmark rates that have been conceived. So there was one alternative that was already tried, which was known as IIBR, but that was not very successful. Now, if we are in 2022 and we want to look back at our literature and see what have been the alternatives that have been conceived in the literature, we find different concepts, different very, very interesting concepts. For instance, some authors have said that if we have to use a real economy-based indicator, why not use one of the macroeconomic indicators, like for instance, inflation rate, like for instance, nominal GDP growth rate, or real GDP growth rate. Or if we are looking at Islamic bank or Islamic financial institution as a entity which is doing investment, why not use return on investment measures like the accounting return on investment measure or the Tobin-Skew measure? Or if we are really looking at managing a portfolio of risky assets, why can't we use, for instance, the price return on investment indices like the stock market index, composite portfolio return, or why can't we use an asset pricing model such as CAPM or multi-factor models? So these are the different viewpoints that have been shared. From the economics perspective as well, there are certain alternatives which have been suggested. For instance, if we are entering into a lease contract, why not we use rental indices? Why not we use the secondary market prices if we are going to be, let's say, trading in assets? So there are certain assets like housing or cars for which there is a very active secondary market, and the price can be easily known based on the active market transactions in these segments. So why not we use the secondary market prices to do our contracts? For instance, in diminishing musharaka, we know that one alternative that has been suggested in the literature is that when we are selling units of a house, why use historical rate? We can use the current rate, and we can enter into a shirkatul aq kind of contract. So that would make the transaction very much like we do in a normal scenario. So it would be risk based, and there would be no mimicking of conventional product as such, if we would use these kinds of benchmarks, which are very much reflective of the kind of activities that we are doing in our contracts. So these are the different alternatives that have been suggested. Another problem that comes in Islamic finance is that if we are going to use a theoretical based asset pricing model, then in such models there is a risk-free rate used. Now in Islamic finance, there is no such security which is completely risk-free. So what is the alternative that can be used? So different authors have suggested different alternatives for the risk-free rate. For instance, some authors use the inflation for risk-free rate. Some have suggested that if you invest in certain assets, you would be able to avoid paying zakat on the total value of investment. And in that case, you are having some kind of a zakat saving. So you can use zakat saving and zakat rate as a measure of risk-free rate, because you will be able to have at least this much return or saving when you are investing in certain assets where the whole value of the asset would not be subject to zakat, only the productive outcome of that investment would be subject to zakat. So these are some of the interesting concepts that have been shared in the literature on what could be the alternative in Islamic finance. Now, if you would summarize different alternatives that are on the table, the one proposal which is coming from this is a bank market to uh, issue of there are other alternatives. For instance, why not we use a interest rate but we develop it ourselves? Why not we use approach? So this is another alternative in the and in the economic view, there are different alternatives. One aspect use the indicator, for instance, inflation rate, for instance, GDP rate, foreign growth. Can you hear my voice?
Yes, now we can hear.
All right. All right, there was I think some problem. So I was speaking about different perspectives and different views which are offered in developing alternate benchmark rates. One view is the interbank view. Interbank view, we are going to look at the practicality of the proposal. We are going to look whether the proposal is suitable enough for short-term financing or not. Because when we talk about interbank transactions, the interbank transactions are going to be having a very short maturity. So the maturity could be just overnight. It could be a transaction which is having a very short maturity. So in that case, we cannot basically be very flexible and using, for instance, diminishing musharaka or jara or musharaka contracts. In that case, we are going to be having a very small set of alternatives, and we have to also keep into account risk element. So if the interbank view is taken, we would be moving very close to what the alternate interest rates are doing, and we would be using them in our system. But if we take a broader picture and a long-term picture, and if you look at the paradigm shift, which is needed in Islamic finance, as argued by many scholars, then in that case, we should take the economic view. In the economic view as well, we have to have just of the practicality of the alternative. One alternative is that we go for macro approach. Now, if we go for the macro approach, then we would be using
Dr. Salman, I think voice is not clear. Again.
Can you hear my voice now?
Yes, please. Yeah.
So I was saying that the economic view has two perspectives. One is the macro perspective. In the macro perspective, we would be using inflation rate or GDP growth rate or sectoral growth rates or capital market based returns on investment kind of benchmarks. Now, in these benchmarks, the benefit is that we could have data for most of the countries, because every country would have data macroeconomic indicators, even if they do not have very developed derivatives market or very developed financial markets or very developed capital market. They would still be having these indicators, these macroeconomic indicators. But the problem with these macroeconomic indicators is that they tell very little and mask a lot of details. Because when we talk about GDP growth rate, it is basically taking into account the growth in all the sectors of the economy. When we talk about inflation, it also basically not just looks at particular kinds of goods and services, it includes quite a lot. So these are average level indicators. They are just indicators for the macroeconomy. So there are pros and cons of these alternatives. The other perspective is the micro-based benchmark. In the micro-based benchmark, we look at our transaction and then we find a suitable benchmark for it. For instance, if we are entering into a lease-based transaction, if we are using ijara or diminishing musharaka, then in that case, rental rates from rental indices could be very suitable. If we are, let's say, using corporate financing in which commodities are involved, maybe we can use commodity price indices as alternate benchmark. The price return on commodity indices could be used as a proxy for profit rate in doing contracts involving commodities. Likewise, if we are using public finance, we can use the average return on asset or average return on equity in public sector enterprises. So these are the different proposals in the micro framework. In the micro framework, we try to match the nature of transaction with the particular alternate benchmark, which is very much related to the activity that we are doing in Islamic finance. Somehow the slides are not appearing. Can you share again? Yes. Can we move forward and discuss these proposals in detail? Yes. So in Islamic finance structures and contracts, one very important issue is that we need to have a Sharia compliant underlying transaction, which is not the case in Software and Sonia, because they are using transaction, they are using treasury securities, zero coupon securities issued by the government as underlying asset, and the transaction nature is also repo based or derivatives based, which is not quite compliant with Islamic principle. This is one problem that we find in these alternate reference rates. So if we are looking for adjusting them and try to accommodate them in our system, we have to keep into account this fact as well. And then another point is that maybe we can use it, but we have to use our own structures. Maybe we can use these alternate reference rates as benchmark, but we will be using our own structures like Murabaha, like community Murabaha, like Java. And in that case, it would be not ideal, but still it would be permissible, just like it was permissible using LIBOR. So when we were using LIBOR, we were not basically doing the repo-based transaction, we were not doing the interest-based transaction, we were doing the Shaikh transaction. Only the rep it was interest-based transaction or interest-based activity, but the transaction itself, which was done in Islamic finance, was not interest-based. So in that case, we can argue that alternate reference rates can also be accommodated, provided that we are able to find a solution for error in pricing in the backward-looking alternate reference rates. Can we move forward? So these are basically the arguments in favor of using alternate reference rates. So we can justify or legitimize the use of alternate reference rate based on the arguments that we have been giving for LIBOR. But scholars and especially Islamic economists say that when these arguments have been overused, and we have been using it since last 40 years, if we are continue to just use these arguments to legitimize alternate reference rate and face this opportunity of transition again, then it might be that again after 40 years or 60 years or 80 years, we are going to be saying that let's keep the things as they are, and we would not be thinking about paradigm shift which is needed. If we are going to look at the arguments in favor, we can find even transactions which have happened. Islamic Development Bank has issued a sukuk on private placement basis, and it used the SOFR, which is an alternate reference rate. So if already Islamic financial institutions like the Islamic Development Bank have ventured into such instruments, then why hesitate? So this is one way of looking at this. Can we move forward? So one issue in intrabank rate is that they are backward looking. Now the alternative could be that we use those alternate reference rates for which forward looking Trump RFRs are available. So the problem with a typical alternate reference rate is that it's a risk-free rate, it's overnight, and it's backward looking. So if we have an alternate reference rate which does not have this limitation of only having a backward rate available, if there are alternatives which are available on forward-looking basis as well, and they are also available on for different maturities as well, not just overnight, then in that case they could be accommodated. Now, one view, which is the intrabank view, is that we accommodate such rates. We accommodate those alternate reference rates for which forward-looking data is also available, and for which Trump data is also available, Trump premium is also available. So in that case, we could use them just like we were using now. Now, this is a short-term solution. This is a solution which is not very popular. This is not a solution which is ideal for us. Can we move forward? Now, the issue comes in that in Murabaha, especially in Murabaha, this problem comes that once the price is fixed, we cannot change it. So what to do if, let's say, the rate keep on fluctuating? We have used a particular rate to enter into a transaction, but during the transaction on different rates, the rates are different. So in that case, what to do? The alternative is that we do reconciliation of profit rate in next calculating period. So we do a next transaction, a separate transaction, which would incorporate the discrepancy or the adjustment factor from the previous transaction. This is one way out, but this is not ideal, because in that case, we are going to be doing a lot of community Murabaha transactions one after the other, and where the objective is very simply mimicking the cash flow stream of a conventional transaction. So this kind of adjustment, rebate, reconciliation, even though this alternative is there on the table, it is proposed by IAFN, but what we are seeing is that the scholars at large are not very convinced about it, even though the industry is very happy, because the industry would definitely look for a solution which is not going to be too much disruptive. So if we want to avoid disruption, then this is one solution, that we use these alternate reference rates for which forward-looking data is available, for which Trump premium is available, and then we incorporate them into Islamic finance transactions. But then in Islamic finance transactions, we avoid the element of change in price after the contract is executed by incorporating the clauses which are allowing for adjustment, which are allowing for reconciliation, which are allowing for rebates from one party to the other party, depending on which way the rate moved during the transaction. All right, can we move forward? So this was the proposal which was given by IAFN. So what they were proposing were two proposals, one based on Murabaha and another based on Ijara. Now the Murabaha based proposal was having variants. One variant was dual tranche structure, and another variant was single Murabaha with 2 undertakings. I would try to very briefly summarize it, because it's quite technical, and I think it might take a lot of time just to explain it, but I would just give a hint, and I think that will be understandable to most of the people who are familiar with commodity Murabaha transactions. So their proposal is that one way out is that you do a murabaha transaction, which is covering the whole of period. And then on daily basis, you would do certain short-term murabaha. And these short-term murabaha would be covering up the daily fluctuation in the rates. And if we want to avoid this structure, that we do not want to engage in lots of short-term murabaha and along with long-term murabaha, if we want to avoid, what we can do is we can have a single murabaha, but which would have undertaking from the bank and also undertaking from the client. And this undertaking would stipulate that the both parties are committing to the other party unilaterally that if there will be fluctuation from the base rate, from the contracted rate, then they are going to compensate the other party. So if the rate fluctuate in favor of the other party, the first party would pay to the other, or if the reverse happens, the second party would pay the first party. So here the point is that, for instance, the contract is done at 10%. Now the rate turns out to be 10.5%. So this adjustment has to be made. So both parties are committing to each other that if the rate deviates from the contracted rate of 10%, then whichever way it moves, whosoever is going to be gaining would pay the other. It's just like the netting that we are familiar with in a futures contract. So this is made Sharia comply way that this is based on undertaking, and undertaking is unilateral, and you can have unilateral undertaking. But this is still not ideal because here you are involving not just one undertaking, you are involving two undertakings. And there is another problem. Another problem is that the ceiling rate has to be very high so that the Islamic bank's risk is minimal. Now, if Islamic Bank wants to basically ensure that, then the other party also needs to be willing to enter into a transaction with a very high rate. Because the other counterparty, if let's say it's a conventional institution, the conventional financial institution would not bother too much about what you are doing. The conventional financial institution would feel confused that what you are trying to do, you are offering me one structure in which there is one murabaha, which is long term, and then there are lots of short term murabaha, which are making up for the price fluctuation, the rate fluctuation during the period of the contract. And you are offering me another contract in which the rate of financing is very high, but you are giving me this undertaking that you would give me a rebate if the rate turns out to be higher for me. So, but this is made Sharia compliant by including two undertakings. Likewise, the same proposal is there with Ijara. In Ijara, there is a daily rental rate which is used over the calculation period, or you can break the calculation period into sub-rental periods. So the issue is same, that you are basically trying to have a mechanism through which you want to be able to adjust the rentals based on the variation in the alternate reference rate. Now, in rental contracts, it's quite easy. In rental contracts, we say that only for the first period it is necessary that the rate should be fixed, and for other periods it is not quite necessary. You can revise the rate. We are quite familiar with floating rate rental structures in long-term ijara and in diminishing musharaka structure. So that is not a problem. The problem is more with murabaha, because in murabaha, no matter whether the contract is for a short term or for a long term, once the price is fixed, you cannot change. So you cannot change the price, but you would try to still change the payoffs by having these reconciliation payments, rebates, and to ensure that you would have to have unilateral undertaking, which is going to be binding. So all of it, seems flimsy to some. To some, it would seem like, well, it's just a manipulation or just maneuvering and just trying to mimic the conventional cash flow stream. And to others, it would seem that at least it is Sharia compliant. There is no problem. You have solved the problem of gharar. You are not using a interest-based transaction or a repo transaction or a treasury security. You are using an Islamic finance transaction, and where you are using alternate reference rates only as a benchmark. Now, if you have forward-looking rate available and if you have term RFRs available, you do not have to do that. In that case, you would simply use those rates which are forward-looking, just like you were using LIBOR, and you would not have to engage in such structures. But if the rate is backward-looking, then this alternative was proposed by IEFF. This was given by them in a white paper, and people are discussing it, and there are also lots of conferences and roundtables in which this has been discussed. And industry is very much liking it, because industry would not want a very disruptive solution. But the Islamic finance practitioners who want to have a paradigm shift, who want to basically look at Islamic finance as a distinctive financial institution, distinctive financial system, they are not quite happy with this. That is why if we look at the regulators like AOF, they are looking for other alternatives as well. They have not just looked at this alternative and concluded that, well, all is done and no need to think more about it. They are still thinking of other alternatives. Now, as we move forward, we are going to see what other alternatives have been proposed as well. Can we move forward? So these aspects have been discussed while I was trying to explain these contracts. The issue of gharar, the permissibility of compounding in areas. This is allowed by and large by scholars, because if you do compounding just as a way of calculation, then there is no problem. You know, compounding is what is just an exponential mathematical function. So there is no problem. In fact, in the dynamics of how population grows, we can use compounding formula. In any exponential function, you would be having compounding. So the issue is that whether the transaction itself is Sharia compliant or not. Compounding is not much of a problem. So compounding in areas is an issue, but it has been resolved, and scholars have given their verdict that at least for just pricing, just for calculation, it's not a problem to use a particular formula. But the issue is with bilateral binding undertakings. Can we allow that? And can we allow rebates? Some scholars are very critical of the element of rebate, because then the transaction in Islamic finance becomes very much like conventional. So the spirit is lost. So and then there is also a need for Sharia analysis of executing multiple murabaha contracts. So for adjustments, if you are going to be using different short-term murabaha contracts during the period of the financing facility, then the problem is that is it allowed? Is it not like you are trying to just mimic the conventional cash flows, and the murabaha contracts that you are entering one after the other, they are just a way to achieve that. They are not genuine sale transaction between two financial institutions. So these are different Sharia issues on the proposal that we have discussed. Now we move to the next proposals. Can you move forward? So I have discussed the pros and cons. The pro is that definitely it's a solution which is not going to be very disruptive, very much acceptable to the industry, still Sharia compliant. But then again, there are possible challenges that we have discussed. Can we move forward? All right. So this is a bottom-up approach. Let me just summarize it for the sake of time. This proposal says that instead of relying on a conventional interbank rate, we should have different Islamic transactions happening, and through which we can drive our own rate. So rather than using conventional alternate reference rates like SOFR or SONIA, and then embedding them in our Islamic finance contracts, what we need is we need to have our own instruments, and the profit which is determined on those instruments could become a benchmark for our own contracts. So in that case, we are developing our own benchmark. This is the bottom-up approach. Now, in the bottom-up approach, the issue is that let's say we give a proposal of government issuing its sukuk, and the price that it would use to issue that sukuk, this price can be used, this benchmark can be used by the Islamic finance industry. Now, it's very easier said than done. The issue is that when the government is deciding its own rate to be offered on the sukuk, what benchmark it will use. So this is a problem of a problem of whether egg comes first or chicken comes first. So you need to have first of all a rate which is completely distinct from the conventional rate, and from that you can drive a lot of Islamic benchmark rate depending on different contracts, different risk premiums, different terms. So you can add different kinds of premiums like Trump premium, credit default premium, counterparty premium, but you need to have a benchmark first, which is not conventional. So if we want to avoid conventional, we have to have a base benchmark rate, which is completely interest free in essence. In that case, one proposal is that we use public sector projects, and in those public sector projects in which the government is a monopsony. So monopsony is a economic structure, is a structure in market where there is single buyer. So we know that governments are single buyer in many contracts, and in those contracts, whatever price they offer, this price can be used to determine a particular profit rate. So for instance, if government is procuring wheat or cotton or anything like oil, and it is paying a particular price for it. So then price minus cost, you can drive a particular profit rate. And this profit rate could be used as a profit rate to issue sovereign securities. Now, these sovereign securities, Musharaka Sukuk or Ijara Sukuk, whatever the structure that is used, can become the base benchmark rate, which can be used by the Islamic financial institution. Now, a little bit more, you can say, disruptive solution, but it's nonetheless very much distinct. It's not like we are just trying to mimic the conventional finance. We are just trying to mimic the conventional cash flows. It's genuinely Islamic. It is genuinely different. So here, the issue is that we are using those public sector projects in which the government is able to know not only the cost, but also the price, because it is a monopsonist. It is the single buyer. It knows what price it is offering. It knows what the cost of the service or product is. So it can calculate the profit rate on that. So we know that there are certain energy projects in which governments themselves commit a particular rate like 10% or 12% or 15%. So they give their own ROI. They give their own estimates of ROI. So if those public sector projects or public sector trade operations could be used to drive a profit rate to offer Musharaka Sukuk or Ijara Sukuk, then these Sukuk rates on such instruments can be used by the Islamic financial institution to drive the base benchmark. So this is one proposal. This is a bottom-up approach. Here, we are not using SOFR or alternate reference rates. We are developing our own benchmark rate from our own issued Musharaka Sukuk and Ijara Sukuk, and then we are going to be saying that the industry could use it, use this benchmark rate to add more credit risk premium, term premium, counterparty premium, and so on. So this is one alternative. Can we move forward? Again, forward. Next slide. Next slide. I think I have already summarized that. So this proposal has lots of strengths. The pricing is based on economic activity. Instrument can serve the monetary functions for central bank as well. An instrument can resolve the liquidity management issue because it would be a short-term Musharaka Sukuk or a short-term Ijara Sukuk. But the possible challenges are that there is no zero floor in certain projects. So you cannot really say that there is no chance of loss. So, and there is more chance of volatility as well. This is the challenge in this proposal. There is no term premium. So when you are using public sector projects to drive a particular profit rate, that profit rate is not taking into account maturity of the project. So there is no term premium. It will have to be added separately. And then another problem is that there are not many sukuk out there. So if sufficient number of sukuk Ijara bills are not out there, then there will be constraints to supporting transaction volumes. Now moving on, can we move to the next slide? Yes. Can we move to the slide where I have discussed the challenges and yes. So here I would summarize this particular proposal. In this proposal, basically, it is said that we use real economy based benchmark. Now, what is the real economy based benchmark? The one thing that comes to everyone's mind is GDP. Now, issue with GDP is that it's just a value of production in a given year. So growth in the value of production in a given year is GDP growth rate. It's not necessarily reflecting profitability. For instance, you could have a company which is doing production higher and higher. It is doing higher production every year, but it is still in a loss. So we know a lot of capital intensive businesses take time to reach break even. So if there is a new airline company or a new railway company, it would not be reporting profits in the first year of operations, not generally. Even though there can be exception, but capital intensive businesses take time to break even. But They are still producing, and their production every quarter, every year is going to be higher from the previous year. So just growth in production does not really reflect profitability. This is one issue with GDP. People very enthusiastically refer to GDP growth rate as a benchmark for profit, but it is not really profit. It is just growth in value of production. If you are selling your output at a lesser price, then your profits could be very low, and they could be negative as well in some cases. So that is one issue. Another issue with GDP is that the lowest frequency that you can have is quarterly. In most countries, it is not reported even on quarterly basis. And in countries where it is reported on short frequency basis, it is quarterly at best. So you cannot have a daily rate, you cannot have a weekly rate, you cannot have a monthly rate. So that is one problem. Another problem is that GDP includes the production of all sectors, including the financial sector as well. So if you are to use such macroeconomic indicators, you have to ensure that you are using either agriculture sector or you are using manufacturing sector. And if you are using services sector, you have to exclude the production value of financial sector, which is by and large going to be conventional interest-based financial services. So these are different issues with GDP. And then there are multiple variants of GDP, whether to allow for depreciation to be deducted. In that case, not net domestic product could be used. If you want to include the external factor as well, like for instance, remittances, export, imports, then you might include GDP. If you want to do personal financing, if you want to use a benchmark for personal financing, then maybe personal disposable income could be a better measure as compared to GDP. So these are different, you can say, discussion points when we are going to talk about GDP growth rate as a alternate profit benchmark. Another issue comes in is that when we talk about real GDP growth rate, it could be negative as well, as we have all seen in this post-COVID situation. So the issue is that if the real GDP is negative, then it means that our base benchmark rate has become negative, which is not going to be very much ideal for the financial markets, because in financial markets we are looking for a stable benchmark which has low positive value. So real GDP growth rate could be negative. And alternative is that we use nominal GDP growth rate. Because if we use nominal GDP growth rate, it would not only be adding up the growth in the value of production, but also it will be adding the growth in prices. So nominal GDP growth rate is real GDP growth rate plus the growth rate in prices. So both together would most probably be positive. But the issue with nominal GDP growth rate is that if, let's say, you have a situation of stagflation. In stagflation, what happens? The inflation is very high, but the GDP is very low. So in a stagflation kind of a situation, you would have a nominal GDP growth rate which is quite high, but the economy is not doing well. And in such cases, what central banks do? They lower the policy rate. And when they will lower the policy rate, the conventional money market rate would also go down. But our benchmark rate in stagflation, because of the element of high inflation, would be comparatively very high. So in that case, we would be having a very big, you can say, gap between the Islamic rate and the conventional rate. So these are some of the challenges that need to be considered when proposing this alternative. Can we move forward? Yes. Can you move forward further? So I have discussed that already. Can we move forward? The nominal and real GDP growth rate. So another alternative is to use inflation rate. So rather than using GDP growth rate plus the inflation rate, why not use just the inflation rate? And there is a case for it, because if we look at the long-term association between inflation rate and interest rate, what we find is that mostly they go hand in hand. Mostly they are correlated. And also there is no base effect as such in inflation rate. In GDP, the problem is that the base effect comes in. If we talk about GDP growth rate of Bangladesh, it is going to be very high, because Bangladesh is a emerging country, but it has a low GDP base. So the growth rate could be as high as 7%, 8% initially. But for developed countries like Germany, like Japan, like USA, because their GDP level is already very high, their growth rate in a high base is not going to be as much as the growth rate in countries like China, countries like Bangladesh, countries like Indonesia, countries like India. So in developing countries, usually the GDP growth rate is very high, but in developed countries, the GDP growth rate is usually very low. Why? Because of the base effect. So this is another problem in GDP growth rate as a benchmark. Now in inflation rate, there is no such problem. There is no such problem because you can rebase the CPI to 100 after every 10 years or so. So there is no such problem of base effect in inflation rate. Plus, the inflation rate is very much correlated with the interest rate. There is a theoretical case for it. There is also empirical case for it. So and also, if let's say all things remain same, then increase in price reflects what? It reflects your profit potential. It reflects high profit potential. So we know from the law of demand and law of supply that if let's say the price goes up, the supply also goes up. And if let's say the inputs remain the same, this reflects high economic profits. So the increase in prices, keeping other things same, is also a good reflection of profitability. And if we are looking for a benchmark which is looking at profitability, then inflation rate is a better measure as compared to GDP growth. Can we move to the next slide? Here I have given the possible challenges in this proposal, because when we talk about inflation, it is calculated in a way in which there are lots of decision points. You have to decide about what weights to give to different kinds of goods and services in the system. What should be the composition of basket of commodities from which you are driving a general price level. What base year to be used? If base year becomes different, then the calculation would completely differ. The frequency of publishing, some are available on weekly basis, some are available on monthly basis, some are available on quarterly basis. And then which audience to look at? Consumer price index, wholesale price index, sensitive price index. There are multiple varieties. And then what formula to use to calculate inflation, chain weighted or fixed weighted, which formula to use. In statistics, we know that index numbers can be calculated using Lespier formula, Pache formula, Fisher formula, all give different answers. So these are what? These are different decision points which have to be noted because based on these differences, the calculation could turn out to be very much different as well. So there are certain strengths in this proposal that is definitely avoiding interest-based benchmark, but there are certain challenges as well. Can we move forward? Yes, this is another proposal which is saying that in particular type of contracts, we have to see that which benchmark is suitable related to the nature of the contract. For instance, if the contract is using ijara or diminishing musharaka and it's a lease-based contract, fixed assets are involved, and let's say we are talking about car financing or home financing, in that case, why not use rental indices? And these rental indices are available or they can be developed as well. I have given one formula to basically drive monthly rent, whereby you would be using different let's say indicators like what is the productive capacity of asset. For instance, when we talk about car is basically giving you an ability to drive for a particular number of kilometers or mile. So you can use this productive capacity and depreciate it over a period of time to drive a monthly rent. And the fare calculation can be used using Uber rates or other transport apps. So this is one way to go about this. And likewise for commodities, the commodity indices can be used. In trade finance, the real effective exchange rate or nominal effective exchange rate would be used. So these are the different alternatives that are tabled, that are conceived, that are basically suggested in Islamic finance as we look for transition away from LIBOR and try to find an alternative which is not only going to be different than LIBOR in form but also in spirit, and especially keeping in view the spirit of Islamic economics, which is to have a risk sharing based, real economy oriented transactions. So in that case, there are different alternatives which are being suggested. Can we move forward? Okay, so this is again the same thing, rental index in the fixed assets finance. So when we talk about diminishing musharaka structure, bank earns in two ways. One is that it wants to basically recoup its own investment by the sale of units. And the other thing is that it wants to have profit as well. Now, if we look at the rental yields across countries, we find that rental yields are between 3% to 6% across countries. The average rental yield per annum is 3% to 6%, and it is quite stable, and it is always going to be positive, and it is always going to be in this range. So it means that this would be a very good base benchmark rate. The rental yield would be a good base benchmark rate to use when the Islamic Bank is looking to basically get profit out of a lease-based contract. So the rental yields could be used to calculate the rents. And when it comes to recouping the investment, the same structure, Indonesian Musharaka, could be used, whereby the Islamic Bank simply divides its investment share into units, and then it sell units over a period of time to recoup its investment. So this is one way. Another way is that do not sell units on historical price basis. You sell it at market prices. And for that, at least in the case of housing, you have a very significant amount of data available on secondary housing, secondary market trading of houses. Like for instance, there are different websites, Zillow, Muda, Realtors, Zameen. So these are different platforms on which real estate is traded, and you can know the current price. And if the sale of units is done at current price, usually the bank would be having a benefit, because we know that in real estate, the long-term price trend is that it goes up. So if the long-term price trend is positive, then in that case, Islamic Bank would be even having increased profitability. And to avoid commercial displacement risk, it could have rebate, it could have certain adjustments, but it would not be having this problem that it is left with less profit as compared to before. So this is another alternative to use rental indices, at least in lease-based contracts. So this is a micro-based benchmark proposal. In this kind of proposal, we are going to suggest different benchmark rates for different kinds of contract structures, depending on the relevance between the benchmark rate and the underlying activity which is being done or part of the Islamic finance contract. Can we move forward? Yes, so these are the possible strengths and possible challenges for this proposal. I think we have already discussed that. Can we move forward? Another alternative is that in corporate finance and also in commodities finance and also in trade finance where commodities are involved, we can use the asset price index. Now, when we talk about asset price index, there are different kinds of assets, financial assets as well as commodities. So in commodities, we have oil, steel, iron, and so on. In financial assets, we have stocks, we have mutual funds, we have other kinds of assets. Now, the one beauty of this kind of data is that it is available on instantaneous basis. It is available on tick by tick databases. So you can have instantaneous price adjustment. So if you're looking for a benchmark which is going to be having high frequency of updation, then in that case, asset price indices are very much useful. They are very much useful because the data is updated instantaneously. But the issue is that this instantaneous data might have more volatility as compared to definitely the fixed income securities or the securities where debt financing is involved. So that is one possible challenge. But the right side is that if we are doing asset-backed financing, if we are doing commodity-based operations, then why not use commodity prices as a benchmark rather than looking at interest-based benchmark? Now, how to drive a profit rate from asset price index? Just a percentage change over a period of time. So, for instance, if we are on Feb 3 now, so the rate of return on Feb 3 is based on the index price on Feb 3 and Feb 2. So you can find a percentage change. This would be a daily rate. You can annualize it. So this could be used. And to reduce the volatility, you might use a moving average, a 3-day moving average or a 5-day moving average or a weekly moving average. So in that case, you would be avoiding the volatility factor as well. So this is another proposal which is being suggested by different authors. Can we move forward? I think now we have reached the very much the end of this presentation. Can you move to the next slide? Yes, so this is basically my last point, and I think I have already touched upon it. Just like public sector projects can be used to drive a base profit rate on a real economic activity, commercial contracts could also be used. For instance, we know that governments also operate in public utilities. They also operate in commodity operations. They also operate in energy projects. So in projects where they are providing energy products, or where they are providing transportation, or where they are providing public utilities, in those operations they are earning certain profit, and this profit could be used as a benchmark as well. Now, to avoid volatility or idiosyncratic risk related to a particular activity or segment or industry, we can use an average. So in our Islamic finance literature, one proposal is that we use the average return on the public sector enterprises. So for instance, if we have a portfolio of stocks in which only the public sector enterprises are represented, and if we compute the portfolio return on that, then basically this would also be a good base benchmark rate. And usually this would turn out to be positive, because in public monopolies, it's very easy to earn a non-rate of profit. And because the price is regulated, you can also have a control over the profit rate. So in the conventional interest rate regime, the central bank wants to have control over deciding, the interest rate. So in this proposal as well, because government is regulating the natural monopolies, public monopolies, and it is regulating the price, it can basically have an influence on the profit rate, which is going to be needed in the financial market as well. Now, definitely these proposals are not quite straightforward. It's not like we listen to them and then just apply. Definitely there would be need for refinement and to make them more robust. But my idea was that I should share these different points so that maybe at least discussion on it, deliberation on it, and we can find out benchmark rate which is going to be useful for the Islamic finance industry. Thank you once again. I have taken a lot of time. Sorry for the delay at the start and also disruption in between, because I was operating from a different location. That is why I could not manage it properly. Sorry for the disruption in between.
Thank you very much, Dr. Salman Ahmed Sheikh, for this wonderful presentation and lecture. MashaAllah, it was very informative and beautiful and wonderful alternatives of pricing in Islamic finance. So I believe all participants and our guests, Alhamdulillah, benefited a lot from your lecture. On behalf of our Islamic Economics Association of Kuwait University, I would like to thank you very much for this time and your effort and for your presentation. May Allah subhanahu wa ta'ala reward you, and nasallallahu subhanahu wa ta'ala an yujazikum anna khairan. Wa barakallahu feekum, jazakumullah khairan, Ustaz. And we would like to thank our online guest, my brothers and sisters and lecturers, professionals around the world, more than 120 on our Zoom platform and as well as in YouTube channel. So we thank you very much for your participation, for your attendance in our lecture. And our thanks go to our management of Islamic Economics Association, especially our Director General, Dr. Ala Al-Ubaid, who is a faculty of Sharia faculty in Kuwait University as well. So Dr. Salman, I think we are almost at the end of our lecture. If you have any concluding remark, please, welcome, please, Dr. Salman.
All right. So you are asking me to conclude?
Yeah, no problem. Yes, please. Yeah.
I would like to thank the management of Kuwait Institute and the participants for attending this lecture. And it's a very important topic. And I would like all of you to use these slides I will share with the professor. and maybe you can look at it and let's think about it. Let's think about how we can basically come up with a benchmark rate which is going to be distinctive, which is going to once and for all, end this discussion that how much different are Islamic banks to conventional banks. So we had an opportunity in the past, in the great financial crisis, we had that opportunity, and it was a very good opportunity for Islamic finance to show that how it is more resilient than conventional finance, how it is more better at risk management than conventional finance. We were able to show that, but we were not able to get away from the pricing part. So this phasing out of LIBOR has provided an opportunity again for Islamic banks to distinguish themselves, and it's our opportunity and it's our duty to be part of this discussion, to be understanding the different alternatives, and maybe with the careful evaluation, with careful suggestions, we can put up proposed model which is going to be more workable and more distinctive. So I would just like to urge all of the participants to spare a thought and think about different alternatives that have been suggested and that are being discussed, because we have to decide this year. We cannot really delay it. So if we would not come up with our own solution in next few months, definitely the time will be lost, and then once we start on a different path, once we start using alternate reference rate as a benchmark, then it would be very difficult to move back to distinct alternatives. So time is very important. The issue is very important for the Islamic finance industry. So I would like the academicians, those who are students, those who are faculty, to also be part of this discussion and give their inputs.
Okay, thank you very much. Barakallahu feekum, jazakumullah khairan. My brothers and sisters, see you again in our next program, next lecture, inshallah. And may Allah bless you all. May Allah bless us all. Subhanakallahumma bihamdik. Ashhadu an la ilaha illa ant astaghfiruka wa atubu ilayk. Wassalamu alaikum wa rahmatullahi wa barakatuh. Yes, Doctor, we'll send you this certificate, inshallah. And we hope to see you again in next another session, inshallah. Yeah, there are some comments in Arabic language. Yeah, they are thanking you as well, saying this is very important lecture and wonderfully presented by the Dr. Salman. Yeah, we thank you very much. Yeah, as well. Okay, see you again. Assalamu alaikum wa rahmatullah.